Investing is like planting a tree. The best time to start was 20 years ago, but the second best time is today. In this video, we're going to explore the world of investing through the lens of age. Why? Because your age plays a crucial role in determining your financial goals, risk tolerance, and investment strategies. Whether you're in your vibrant 20s, your bustling 30s, your contemplative 40s, or your seasoned 50s and 60s, there's a tailored approach to investing that can help you achieve your financial aspirations. Each age group has unique opportunities and challenges when it comes to investing, and understanding these nuances can make a world of difference in achieving your financial goals. So, let's begin, step by step, age by age, and ensure that you're on the path to financial success and security. Investing in your 20s. Your 20s mark the beginning of your financial journey, and it's a decade of incredible opportunity. During this period, you have the advantage of time, which is a valuable asset for investors. Let's delve deeper and break down in detail how to invest wisely in your 20s. 1. Establish an emergency fund. One of the first financial steps you should take in your 20s is to build an emergency fund. This fund serves as a safety net, protecting you from unexpected expenses or setbacks such as medical emergencies, car repairs, or job loss. Aim to save at least 3 to 6 months' worth of living expenses in a high-yield savings account. While it may not seem directly related to investing, having an emergency fund allows you to avoid dipping into your investments prematurely in case of financial emergencies. 2. Invest aggressively. Time is your greatest ally in the world of investing. During your 20s, you can afford to take more risks with your investments because you have a longer time horizon to weather market fluctuations. Consider allocating a significant portion of your investment portfolio to stocks or equity-based investments. Diversification is key to spreading risk, and one effective way to achieve this is through low-cost index funds or exchange-traded funds, ETFs. These instruments provide exposure to a broad range of assets and help you participate in the growth of the overall market. 3. Leverage retirement accounts. While retirement may seem distant in your 20s, it's crucial to start saving early. Take advantage of employer-sponsored retirement accounts like 401k, especially if your employer offers a matching contribution. Contributing enough to get the full employer match is essentially free money that can significantly boost your retirement savings over time. Additionally, consider opening an individual retirement account, IRA, to further supplement your retirement savings. The power of compounding interest can greatly benefit those who begin saving in their 20s. 4. Educate yourself. The foundation of sound investing is knowledge. Use your 20s to educate yourself about various investment vehicles and strategies. Learn the basics of stocks, bonds, real estate, mutual funds, and other investment options. Read books, attend seminars, and follow reputable financial news sources to stay informed. If you're uncertain about your investment decisions, consider consulting with a financial advisor who can provide guidance tailored to your financial goals and risk tolerance. 5. Be cautious with taking on debt. While it may be tempting to take on debt for various reasons, be cautious about accumulating high-interest debt. High-interest loans, such as credit card debt or personal loans, can erode your financial progress and hinder your ability to invest. Focus on paying off student loans and other high-interest debts to free up more funds for investing. Developing good financial habits, such as living within your means and budgeting, can help you avoid unnecessary debt. Investing in your 30s. Entering your 30s often comes with increased financial responsibilities and a deeper understanding of your long-term financial goals. It's a decade where you need to fine-tune your investment strategy and make choices that set the stage for your financial future, as it's where you may find yourself settling into a career, starting a family, or making significant life decisions. As such, your investment strategy should evolve to accommodate these changes while continuing to build wealth for the long term. Here's a more detailed look at investing in your 30s. 1. Review and adjust your goals. The beginning of your 30s is an excellent time to reassess and possibly adjust your financial goals. This decade often brings significant life changes, such as marriage, starting a family, or purchasing a home. Each of these milestones can impact your financial outlook, so the need to assess your short-term and long-term objectives is important, and also to ensure your investment strategy aligns with these goals. Whether it's saving for a down payment on a home or planning for your child's education if you have one, a clear understanding of your objectives is crucial. Your risk tolerance may also change as your financial situation stabilizes. Take time to evaluate whether your current investments align with these updated objectives and risk preferences. 2. Diversify your portfolio. As your financial situation stabilizes and your income typically increases, consider diversifying your investment portfolio further. While stocks remain an essential part of your strategy, you may want to add other asset classes, such as bonds and real estate investment trusts. Work with a financial advisor to determine the ideal asset allocation for your specific circumstances. If possible, this the decade you can also opt to explore international investments to broaden your exposure to global markets. 3. Increase retirement contributions. Your 30s are a prime opportunity to boost your contributions to retirement accounts. Building on the foundation you laid in your 20s, continue to prioritize contributions to retirement accounts. Maximize your contributions, especially if your employer offers a matching contribution. By contributing the maximum allowable amount, you take full advantage of tax benefits and compound interest. 4. Automate investments. Life in your 30s can be hectic with career demands, family obligations, and other responsibilities, so it's essential to make investing as effortless as possible. To ensure consistent savings and investment, set up automatic contributions to your investment accounts. Automating your investments ensures that you consistently save and invest, even when life gets hectic. This disciplined approach can help you stay on track toward your financial goals. 5. Plan for children's education. If you plan to fund your children's education, now is the time to start saving. One effective way to do this is by opening a 529 college savings plan. These state-sponsored plans offer tax advantages and allow your investments to grow tax-free when used for qualified educational expenses. Starting early gives your investments more time to grow and compound, easing the financial burden of higher education. 6. Manage debt responsibly. Your 30s may be a period when you're juggling various financial responsibilities, including mortgages, car loans, and student loans. It's important to manage your debt wisely. Prioritize paying off high-interest debts. Reducing your debt burden not only frees up more funds for investing, but also improves your overall financial stability. 7. Consider a home purchase. For many individuals, buying a home is a significant financial goal in their 30s. If you're contemplating home ownership, carefully evaluate your financial readiness. Ensure you have a substantial down payment saved. Understand the costs associated with home ownership, like property taxes and house maintenance, and secure a mortgage that fits comfortably within your budget. Purchasing a house may also not be a priority for some, as other people prefer renting. So don't pressure yourself to own if you aren't ready, as owning a house does come with its fair share of expenses and maintenance. 8. Develop an insurance account and continuously review it. It's important to open an insurance account in your 30s if you don't have one and reassess your insurance coverage. This may include life insurance, disability insurance, and health insurance. Ensure your life insurance policy provides adequate coverage for your family's financial needs in case of your untimely passing. Disability insurance is also crucial to protect your income in case of an unexpected disability. Lastly, review your health insurance plan to ensure it meets your family's healthcare needs. 9. Set up a will and power of attorney. It may seem early for some to create a will, but having estate planning is essential even in your 30s, especially if you have accumulated investment assets early in life and have a family. Consult with an estate planning attorney to establish a will or a trust fund. A will outline how your assets will be distributed in the event you aren't around, ensuring your wishes are respected. Additionally, you may also consider setting up powers of attorney for healthcare and financial matters to designate trusted individuals to make decisions on your behalf if you become incapacitated. Investing in your 40s. Your 40s are a critical period for solidifying your financial security and preparing for retirement. This decade often comes with added financial responsibilities, and your investment strategy should reflect these changes. To navigate your investments during this crucial period, let's look at what's essential in this decade of your life. 1. Fine-tune your asset allocation. In your 40s, it's essential to review your investment portfolio and adjust your asset allocation to align with your long-term goals and risk tolerance. By now, you may have accumulated substantial assets, and your investment strategy should focus on preserving and growing your wealth while managing risk. Consider shifting a larger portion of your portfolio toward more conservative investments, such as bonds and income-generating assets. While stocks remain important for growth, reducing exposure to high-risk investments can protect your wealth from market volatility. 2. Emergency fund maintenance. While building your emergency fund was a priority in your 20s, maintaining it remains essential in your 40s. Ensure that your emergency fund remains adequate, especially if you have added financial responsibilities such as mortgages and children's college expenses. A robust emergency fund can provide peace of mind and prevent you from tapping into your investments during unforeseen financial crises. 3. Catch-up retirement contributions. By your 40s, you should be taking advantage of catch-up contributions available in retirement accounts. These additional contributions are allowed in both 401ks and IRAs, and they can significantly boost your retirement savings if you haven't saved as much as you'd like. Catch-up contributions are particularly valuable if you're looking to bridge any gaps in your retirement savings and accelerate your path toward financial independence. 4. Consider tax-efficient investing. With higher incomes and more significant assets, you'll likely face increased tax obligations. Explore tax-efficient investing strategies to minimize your tax liability and maximize your after-tax returns. Consider using tax-efficient funds that generate fewer taxable distributions and implement tax loss harvesting to offset capital gains and reduce your overall tax liability. Efficient tax planning can enhance your investment returns and preserve more of your wealth, so consulting with a tax advisor can help you navigate complex tax planning strategies. 5. Review insurance needs. With a family and growing financial obligations, it's crucial to reevaluate your insurance coverage in your 40s. Make sure your life insurance is sufficient to provide for your family's financial security. Also, consider disability insurance to protect your income in case of illness or injury. As your assets and family's needs grow, insurance becomes an even more critical component of your financial plan. Consider consulting with an insurance professional to evaluate your insurance needs and make any necessary adjustments to your coverage. 6. Continue debt management. While you've likely made substantial progress in paying off debts by your 40s, it's essential to remain vigilant about debt management. Focus on eliminating any remaining high-interest debts to free up more funds for investing and achieving your financial goals. 7. Estate planning. Estate planning becomes increasingly important in your 40s too, especially if you have accumulated more assets from your 30s and have dependents. If you didn't do this in your 30s, then this is the time to do it. Consult an estate planning attorney to establish or update your will, trust, and powers of attorney. Ensure that your assets are structured and distributed according to your wishes and that your loved ones are protected. Estate planning can also involve strategies to minimize estate taxes, which can be significant for larger estates. Investing in your 50s and 60s. Your 50s and 60s are a pivotal time in your financial journey as you approach retirement. It's the time when you need to focus on preserving and growing your wealth while ensuring you have a solid plan in place for your retirement years. Let's delve into greater detail on how to navigate your investments during this stage of life. 1. Retirement planning. At this stage of life, retirement planning takes center stage. It's the last opportunity to fine-tune your retirement plan before you begin your transition into retirement. Create a comprehensive retirement plan that includes your desired retirement age, estimated retirement expenses, and potential sources of income such as pensions, Social Security, and investment returns. Ensure your investment strategy aligns with your retirement timeline, risk tolerance, and income needs. If your retirement savings fall short of your goals, consider adjusting your retirement age or exploring ways to increase your savings rate. 2. Asset protection. As you get closer to retirement, protecting your assets from market volatility becomes paramount. You'll want to shift your investment portfolio toward a more conservative investment allocation to protect your assets from market volatility. Consider reallocating a larger portion of your portfolio into stocks, bonds, and income-generating assets like real estate, which tend to be less susceptible to market fluctuations. This approach can help safeguard your wealth and ensure that you don't experience significant losses close to your retirement date. However, it's essential to strike a balance between growth and preservation of capital to ensure your savings last throughout retirement. 3. Continue debt management and use it to your advantage. While reducing and eliminating high-interest debt should have been a priority in your earlier years, it remains relevant in your 50s. Focus on paying off any outstanding debts, especially mortgages. Reducing or eliminating debt before retirement can significantly reduce your monthly expenses, making it easier to maintain your desired lifestyle on a fixed income. 4. Healthcare planning. Healthcare costs tend to rise as you age, making healthcare planning a crucial consideration in your 50s. Review your health insurance coverage and assess your potential healthcare needs in retirement. Consider purchasing long-term care insurance to help cover the costs associated with assisted living facilities, nursing homes, or in-home care. By factoring healthcare expenses into your retirement plan, you can ensure you're financially prepared for potential medical needs. 5. Estate planning. Estate planning takes on even greater importance as you accumulate assets over the years. Continue working with an estate planning attorney to fine-tune your estate plan, including your will, trust, and powers of attorney. Ensure your assets are structured to be distributed according to your wishes and that your loved ones are protected. 6. Diversify income sources. Diversifying your sources of income is essential in your 50s. In addition to your retirement savings, explore other income-generating options such as rental properties, dividend-paying stocks, or part-time work. Just because you are retiring doesn't mean you should do anything at all. Having a diverse range of income sources can provide financial stability and flexibility in retirement, reducing your reliance solely on retirement account withdrawals. 7. Review your investment fees. As you near retirement, it's crucial to assess the fees associated with your investment accounts. High fees can significantly erode your investment returns over time. Consider consolidating accounts and moving assets to lower-cost investment options, such as low-cost index funds or ETFs. Reducing investment expenses can enhance your overall returns and help your retirement savings last longer. 8. Embrace tax efficiency. Tax efficiency continues to be important in your 50s. Consider tax-efficient investment strategies to minimize your tax liability in retirement. This may involve strategies like tax loss harvesting, which can help offset capital gains and reduce taxes, and strategically managing your withdrawals from tax-advantaged retirement accounts to optimize tax efficiency. 9. Social Security optimization. Start thinking about when to claim Social Security benefits, as this decision can significantly impact your retirement income. While you can begin claiming benefits as early as age 62, delaying can result in larger monthly payments. Carefully weigh the pros and cons of claiming at different ages, taking into account your financial situation and longevity expectations. 10. Stay informed and seek professional guidance. Staying informed about financial and investment trends is crucial in your 50s. Economic conditions and market dynamics can impact your investment strategy as they tend to change as years pass, so staying up to date is essential. Additionally, continue to work with a qualified financial advisor who can provide guidance tailored to your retirement goals, risk tolerance, and evolving financial situation. Regularly review and adjust your investment strategy to align with your changing circumstances. Your investment journey is a dynamic and evolving process that should align with your age and life stage. Regardless of your age, the key principles of disciplined saving, strategic diversification, and continual education remain essential. Keep in mind that individual circumstances may vary, so it's crucial to consult with a financial advisor who can provide personalized guidance tailored to your unique financial situation and aspirations. By diligently following age-appropriate investment strategies, you can maximize your financial potential, secure your future, and ultimately achieve your financial dreams.